I would then suggest that we immediately jump into the first paper titled "All That Glitters Is Not Gold, a Conjoint Analysis of Equity." So please, Yifat, take over.
Thanks so much, and I will share my screen now. Okay, so thank you for organizing this truly fantastic conference. And I will present a very preliminary study phase where we're really excited to get all of your comments. You don't need to pull your punches because we are still working on the survey design and we can change everything. So we're really looking forward to get your advice. And this is a joint project with my co-author, Omar Vasquez-Duque from the Rock Center at Stanford University. So imagine that you get a job offer from a startup company. Typically, it would involve getting part of your compensation in the form of stock options or maybe RSUs. For instance, this example comes from one of our study participants who chose to deduct $2,000 off of her monthly salary. And the thing is about this decision is that it is really complicated decision to make. It involves multidimensional and intertemporal trade-offs. So when you need to decide between salary and equity-based compensation, you are deciding between getting fixed income and an income you need to calculate, and it requires some knowledge in financial instruments. We're deciding between the short term and the long term, certain compensation versus uncertainty, liquidity, where you can use the money at the end of the month and buy groceries with it, versus waiting until the company holds a liquidity event in order to make money, and living comfortably now versus the opportunity to get a game changer result, or maybe you can view it as some sort of a lottery ticket effect that you can really transform your life. Even with just considering the equity component itself, we're trying to compare between offers from different companies or negotiate an offer with one company. For example, some unicorn companies allow employees to choose between stock options and RSUs, and comparing between vesting schedules, how long will you need to work in order to earn the grant, the exercise price, how much money will you need to pay in order to become a shareholder. And then there is the capital structure of the startup itself. What is the valuation? And then how much money was raised from venture capitalists, and that would give you some idea about the liquidation preferences stack that the startup had. So there are really complicated trade-offs to make, and this kind of situations lead to approximate rather than accurate decision-making process. What also adds to the complexity of the process is that, at least in the US, there is no obligation, no legal obligation to disclose relevant information to employees, because under Rule 701 of the Securities Act, until the company reaches the threshold of issuing $10 million worth of equity-based compensation in a year, the company does not need to disclose any meaningful information. So what we set out to do in this study is to explore how does employees' bounded rationality and then other factors that I mentioned, such as financial illiteracy and lack of relevant knowledge, affect compensation design. So companies can react to employees' perceptions about value and design the compensation in a way that it would look more valuable than it is. So to study this question, we gathered a sample of American startup employees who received equity compensation. And here I'm going to present the results from a preliminary study that includes 237 participants that we gathered through the sampling platform called Lucid. But we plan later on, after we get your feedback, to work on our design and then work with research partners to get a larger sample. And the sample is composed of roughly half and half first-time startup employees versus employees who have worked for more than one startup. 32% female. Our participants have a high degree of education, 33% college degree, many more have graduate degrees, and lots of them have managerial experience. And one of the things that is really unique about the way we're trying to study this issue is that we're borrowing a methodology from marketing research. So a conjoint analysis is often being used in marketing. For example, if I want to sell cell phones and I want to know how much consumers are willing to pay for different types of cell phones, I can break it into different attributes. For example, the brand, the screen size, the color, the price, and then within every attribute, there are different levels. For example, for the attribute of brand, there are iPhone, Samsung, Sony, and so on. And then I take my consumers and I present them with different combinations of those levels and ask them to choose the product that they would have chosen in real life. And I repeat this process multiple times. And then using a series of logistics regressions, I can infer what is the utility that consumers derive from different levels. And I can later transform it into a whole bunch of interesting insights. For example, what is the most important attribute? What is the relative preference for each level within attribute? How much consumers are willing to pay for different levels? I can also look at different market segments and compare how they behave, and so on. So we're trying to take this methodology and treat the compensation contract as if it was a product, and then break it into attributes and levels. And ask our participants, imagine that you have offers from more than one startup, and they vary only in the ways that you can see in front of you. Which one would you prefer if it was happening to you in real life? Would you prefer a higher cash salary or a shorter vesting schedule, and so on? So to go into a little bit more details, the attributes that we chose to use are the salary, where the range is between $210,000 a year and $240,000 a year. The valuation, we intentionally kept it in a very narrow range because we didn't want it to have strong interactions with the other variables in a way that's going to change the value of the grant. The amount of the venture capital that was raised, and here we know that the more venture capital was raised, if we're looking at two startups that have similar valuation of $1 billion, one of them had raised $50 million and the other is $650 million. The first one is going to have common stock with greater value, but we suspect that employees might view this market signal differently. The other variable that we think that employees might not interpret in completely rational way is the exercise price. We suspect that it might be a non-salient component that employees don't always factor in. They don't always understand what it means. And here we chose to treat RSUs as if they were stock options with a zero cost to exercise. And we wanted to see if employees respond differently to a stock option with the cost of 1 cent versus an RSU. And lastly, the vesting schedule. So we know from behavioral economics research that it's really hard for people to transfer values through time. And the more immediate a reward is, the more valuable we view it. And then longer in the future, we're not using the same discount rate. And so we wanted to see what will happen if we play with the vesting schedule. How will employees' perception of value is going to change? So the first thing that we noticed was that when we asked our study participants after the conjoint task, what were the factors that mattered the most to you, that guided your decisions, most of them mentioned the salary, some mentioned the vesting schedule. Almost none of them mentioned the amount of the venture capital that was raised by the startup. But the most important attributes, just by looking at the actual choices that the respondents make, were the amount of venture capital that was raised by the startup, the cash salary, and the vesting schedule. And the valuation and the exercise price mattered less. It could be also related to the fact that they had really narrow ranges. And then the main result that we got at this point in our study shows what level does the average employee prefer, where a high positive value means that there is relatively high preference, and negative values mean relatively dispreference. So we can see that the way employees responded to the amount of venture capital that was raised by the startup was that the more money the startup had raised, the more the employees were willing to take that offer. And we think that this is interesting because employees don't have a lot of indication about the value of the equity compensation that is being offered to them. So they are looking at what venture capitalists are doing, and they are trying to do the same. This is also something that Shai Berenstain and others have pointed out in a different study using data coming from AngelList. This is maybe one of the strongest indications that employees rely on when they are looking at different compensation arrangements. The second thing was the exercise price, and here, probably because we used too narrow range of different exercise prices, we didn't get significant differences, but we see that with lower exercise prices and with the RSU, employees responded more favorably versus the higher prices where employees responded to it. So overall, it does seem like a rational response. And with the vesting schedules, so switching, or we can see that a higher or longer vesting schedule of 5 years creates really strong response from the study participants of this preference. But then looking at a 2 years vesting schedule or 3 years, it's pretty much the same to them. And we can look at the same results in their impact on the actual cash compensation. So here we look at a baseline of a startup with valuation of $1 billion that had raised $50 million from venture capitalists, where the exercise price is 1 cent, and the vesting schedule is the typical 4 years vesting schedule. And then what would be the cost of switching to a 5-year vesting schedule? Here, the employer is going to need to offer $20,000 more to the employee for the employee to accept that offer. So it could explain in a way why we see the 4 years vesting schedule being so sticky, even though there is a lot of writing and talk about the fact that it takes much longer for companies to go public nowadays, and the 4-year vesting schedule no longer fits the time horizon of startups, but still it's complicated to switch from that standard that became an anchor in the industry. But if we're offering the employee a shorter vesting schedule of 3 years or 2 years, you can offer a lower cash salary by roughly $10,000, and the fact that it's 1 year less or more doesn't really matter. Looking at the amount of venture capital that was raised by the startup, again, if two companies are competing against each other, one had raised $50 million and the other had raised $650 million, the latter could offer lower cash salary by $20,000 because of the perceived value that employees assigned to the equity compensation of the latter. And then lastly, talking about the exercise prices, so we can see that they have influence in our next iteration, we will use a wider range of exercise prices, so hopefully we can get more meaningful variation in that respect. So what does it mean, or why is it important? I will try to link our findings to a larger literature that exists on why do companies offer equity-based compensation to non-executive employees. So employees view it as kind of a puzzling phenomenon because employees cannot diversify or hedge their exposure. And so if the company takes the same security, stock option, for example, and offers it to an investor who is able to diversify or hedge, the investor should be willing to offer a higher price for the same security. Employees are not good bearers of risk. And so and it would make more sense for the company to sell the securities to the investor and then use the cash to pay higher salaries. But still, we are seeing that it's very, very prevalent for technology companies to offer equity-based compensation. It's also puzzling because lower rank employees cannot directly affect stock prices. So it doesn't seem to be a very good way to incentivize them to maximize shareholder value. And then employees' marginal gains from trying to increase their productivity are going to be really low, which would lead to a free riding problem. So there are many explanations in the literature why we still observe this wide use of equity-based compensation for lower or rank-and-file employees. Most of the explanations rely on data that is coming from public companies, but it is also, to some degree, tells us something about what's going on in startup companies. So the first thing is the selection of risk-seeking employees who are bullish about the technology. The second explanation is that employees are being over-optimistic and they do not do this discounting properly. And then, of course, there are cash constraints, especially for startups. They don't always have enough resources to pay high cash salaries, and so they need to use equity-based compensation in order to attract top talent. About this particular point, there is mixed evidence because we also know that the companies who are able to pay higher cash salaries also offer higher cash equity-based compensation. And so I think that the most convincing reasons that exist in the literature relates to retention. So through the vesting schedule and also the tax mechanism that creates some sort of golden handcuffs, by using equity-based compensation, employees are able to lower the churn rate of employees. And by doing that, they're also protecting their core assets of human capital and intellectual property. And what we hope that our study is going to add to that literature is that the psychological effects of equity-based compensation are not necessarily the same as the economical effects of this compensation device. And because employees don't always know or don't have the tools to understand exactly what they invest in, this leaves a lot of leeway and room to maneuver to the company. Especially in those situations that we talked about yesterday, for example, when a company is facing some level of failure. And because employees don't know what to expect in a different exit scenario, they don't always know how much they stand to gain. There is a lot of flexibility of post-ante bargaining to assign cash flow rights between the investors and the founders, without getting a pushback from the employees. So as for the take-home message, so successful startups start everywhere, but Silicon Valley's model for scaling and investing in startups is really unmatched in its ability to create impactful leading companies. And part of that model is using equity-based compensation. But still, there is very little research about employees as startup in their dual capacity as capital providers while also being labor providers. And the model of the Silicon Valley way of using equity-based compensation is based on deregulation of this domain. And this type of flexibility of providing very little information has its advantages, but I think it should also make legal scholars uncomfortable in the sense that we are offering securities to naive investors who don't always make very informed decisions. Thank you very much, and I look forward to your comments.
Thank you, Mila. Matthias, you'll join with your discussion?
Yes, thank you. So thanks a lot to the conference organizers for giving me the opportunity to discuss Yifat's paper. And thank you very much, Yifat, for the great presentation. So that really allows me to skip immediately into my comments instead of re-summarizing what she's already been summarizing greatly before. So what is the problem here? Well, the broader topic is equity compensation. And as Yifat said before, we often observe it for public and mature companies. And there we know it's typically used because of this separation between ownership and control. And so we want to address this agency issue by aligning the management with the investors, by making management investors too. But this paper says, look, equity compensation is actually also used quite a lot among private, young, startup companies. And here's a picture of one that I once helped with. So that may be the only reason why I'm allowed to kind of discuss this now, or somewhat qualified. And so there's multiple reasons then why they may do this, as Yifat said in the end. I think one key one I could come up with is definitely it's different from the agency issue. Is really they don't often have the liquidity to begin with, and so they really, to attract and retain talent, they use this to make it more interesting to get the talent. But then the question clearly is, why would the talent be interested in the equity? Because equity compensation is risky, and most people are risk averse. And so we would not necessarily like this, in particular not if we're already tying our human capital to a given firm. If we're additionally tying now our wealth and income to a given firm, that's really poor diversification, in particular for startups. If you think of kind of this power law, it's only very few of them that actually don't fail in some way or another. And that get successful. So this is super risky. And as Yifat also said, in essence, a lottery. So why would you take the lottery? Is this a first indication that people are just being screwed over here? Well, that's not 100% clear, because you can, for example, think of this complementarity between income and status. And I think it was shining through when Yifat talked about this game changer. In the end, if you're really one of the ones that gets successful, you're suddenly getting all this status, and with this status, you get in clubs that you wouldn't have ever gotten in before, and then having money is really important. So the marginal value of your money is state dependent and really changes with this with the status. And so Becker et al. have a paper, for example, which could easily rationalize why you take these lotteries. But that still doesn't mean that, well, the companies can't now take the equity compensation and all the complexities in it to screw over their employees, as somewhat was the worry in the background. And this could really lead to misallocation of talent, and it's possibly quite costly for the economy. Ex ante, though, I'm not 100% sure that this, if we're just thinking about it from first principles, that this is a clear equilibrium that the talents get screwed over. Why? Well, I said before, this is a way to attract talent in a war of talent. And so this really means a given talent has lots of offers. And so it's a high stake decision for this talent. And the talent will try to get as much information as possible to decide on the best one to get to. And then, yes, the question is, do they get the information? And here Yifat said, well, the companies are not obliged to give it out. but at least here's the other point where I may have some expertise at least. So I'm an accounting scholar, so I know a bit about information exchange, and usually firms give it out voluntarily if they really want someone to come. And so not being obliged to do it doesn't mean that they're not giving out the information. And here in particular, the startups are competing with each other and other companies. And so they try their best to come up with a competitive pay package. And so they try to talk a lot to the talent. I know we try to talk a lot to all these coding professionals that are very rare as talent, and we provide a lot of information. We try to convince them. Of course, you can get into hyperboles there, and people may try to oversell and give the wrong impression, but their competition kicks in again. Other companies then have the incentive to tell them, look, what they are telling you is actually not quite right, because if you factor this in, our offer is actually better. So it's not clear that, given that this is used in this war for talent, it's really in equilibrium, something where the employees or the talent can get screwed over. Now, what does the data suggest? So they use this cool survey type data, the Conjoint analysis, which I also had once in a marketing class before. So this is how much I know about it, but it shows significant scope for deception and misallocation based on that data. And most notably, it's two things. One, actually, I've seen this new version looked a bit different in terms of the RSUs. I think the version I got there with the RSUs, the restricted stock option, it was still that it looked like they didn't really treat it as a free option. Or a free equity that you're getting. And so the overall question was, okay, the exercise price doesn't really seem to matter that much here. And in particular, RSUs don't seem to be really treated as they should be. So this is a first indication that the survey participants didn't really understand it. And the second big one, which still survived, which I'm happy about too, otherwise I wouldn't have much to talk about here, is the venture capital raised, which is viewed as a positive by the survey respondents. But as Yifat says, look, if we're holding everything else constant, then this just says there's more dilution, or you have the seniority effect in essence, that you first need to pay off the venture capital and then the rest can be distributed. So it should be negatively valued. So then the question is, okay, we'll see that the survey participants don't really act as they should. Why could that be? And if we think a bit about the survey design, the first thing that comes to mind is that if you look at this, it's low stakes but high complexity. And the high complexity, I agree, is the same in the survey as in real world. It is a complex decision. The low stakes, I think, though, is very particular to the survey then, because here you're not making a life-altering decision, and that could lead you to primarily just go with, okay, higher things are more valuable, so I go there, and you click through this a bit with less care than one would want as a researcher. And what could be a result of that? Well, it would, for example, suggest that many of the relative importance of these different attributes, that they are very similar, and here they're all very close to 20%, and that's a bit of an indication to me that this may not necessarily work that perfectly, because the conjoint analysis, one of the main things we get out of it is really this relative importance of the different attributes. And here they seem to cluster all very closely together, which could suggest that people were not too careful in trying to do all the numbers, which I looked at it and I would have had to spend a lot of time to do that too. So that's why I'm sympathetic with the survey participants there. The second one is something that Yifat already also talked about, is the parameter ranges. And in particular, if we're thinking also about this exercise price, there we don't see that this necessarily completely lines up, or these things are significant. But if we think about this a bit more economically too, even if the people don't really react to the exercise price, would they make a big mistake in reality? And that's where we can go back a bit to, startup equity and options is usually out of the money or worthless for most of them. And so it really just matters in the big bang, in the unicorn scenario. And in those scenarios, then suddenly whether you're paying $0.1 per share or $1 per share, really this this isn't important, because then we're talking about millions that you can make in terms of the shares, and then kind of even 100,000 of exercise price is not going to be that important there. And so that could be some rational inattention that this is a number that they really don't need to care about that much. And the last thing in the survey design that I was wondering about is, in essence, this impossibility of an all else equal. Because, as Yifat said, look, there's different product features that are traded off against each other. And with cars, you can have different colors, different tires and the like. But here, the features are economically linked. In particular, if we're talking about valuation and capital raised, those tend to be linked through rational expectations, they both reflect some growth options, etc. And then the question is, can we really have greater capital raised, all else equal, without changing how much shares the venture capital actually got, or how they see the growth options? I don't think this is that easily doable. And if that's the case, then as a survey participant, while valuations are quite uncertain, but capital raise is quite tangible. I know someone was willing to pay a lot for this company already. So maybe this takes on a signal for future outlook and future status that this company gives you. And in particular, if we're looking, this goes back a bit to the ranges. If we're now looking at the numbers, I just plotted here the VC deals over the last 20 years. This top range that they use, the 650 million, really puts you into the 0.2% of the VC deals. And even if you're aggregating by company over all VC deals that the company got, it gets you into the 0.5% of them. So the highest number really tells you a bit, okay, this seems to be one of the unicorns coming up there. So maybe that's why they were so excited to join those. So in conclusion, I think this is a super important paper, which has a novel angle here and goes after a little studied phenomena, equity compensation in private companies and young startups. And as we've heard yesterday, because of the growth of the private market, this is important, increasingly important. So this is a very timely study. The suggestions are just these two, potentially simplifying the survey design, maybe bringing it down to an individual trade-off instead of this joint trade-offs, more similar to some work that Yifat had done before. And in terms of the inferences, talking a bit about, okay, even if a survey shows significant scope for misallocation and deception, how much should we be concerned in practice about it, given that this is often used in this war for talent and we have this competition around there? Are there other kind of mechanisms in practice that reduce the concerns and inform the survey participants so that they don't make the mistakes they do in the survey? So that being said, it's a great paper and project, so best of luck with it.
Thank you, Matthias, very much. And I'll give the floor immediately to Sophie for her discussion.
Hi, everyone. Thanks for inviting me to discuss this very interesting paper today. And Yifat, congratulations on a well thought through paper and raising lots of different issues that exist in the world of equity option grants or equity incentives. It might help if I just give some background about who I am and what I do, so you understand, I guess, the perspective I'm coming from. I'm Sophie Mcgrath. I'm a partner in the technology and life sciences team at Goodwin Procter, which is a US law firm. I'm based in London, and I do what we call life cycle advisory work. So I advise startup companies from a very early stage through all of their funding rounds and towards exit by way of IPO or sometimes M&A. I primarily counsel UK and European companies, but because I'm at a US firm, we have a lot of transatlantic deal flow, and we're often advising US venture capitalists investing into UK and European companies, which gives us good visibility on the differences in terms between, for example, the US and the UK and Europe, and there are some differences. But I say all of that with the sort of lens that, I know this was a very US-focused study, and some of I'll touch on it at some point, but some of the parameters, particularly around salary, are very different to what we would see in the UK and Europe. And I can see why some people prioritized cash in that instance. So I guess if we take it back to brass tacks in terms of why do these companies issue equity in the first place? And I think think there's a huge difference between the very early stage companies, late stage private companies, and public companies. And when I talk about public companies, I mean public companies that have come from a VC-backed grounding. So maybe the Slacks of the world or Snowflake, that type of company. In the early stage, I think the cash constraint issue is real. I think these companies do not have huge amounts of cash to be able to pay cash salaries that are comparable to other options. So if you go to these companies, almost invariably, you're accepting that you're going to get paid less than you'd get paid if you took a job in a more established industry. And the company's attempt there is to try and even that up a little by giving you an equity grant that hopefully compensates you for what you're giving up by not going to work as an analyst at Goldman Sachs, for example. That in and of itself is a hope value exercise. You take that equity, not because of what it's valued at today, because invariably it's got no value. You take it because you form a view, which of course is going to be driven by your own personal biases and decision-making process, as to what that equity might be worth at some future point in time. So I think that's the analysis around the early stage. The late stage private's an interesting place because, by then you maybe have some external valuation on the company. Either you might have product, you might be in the market, you might be generating revenue, or you have at least raised capital from external sources at such a level that there's some sort of market consensus around what your valuation might be. Even so, I think, and what's happened this year in 2022 to private company valuations and public company valuations in the tech sector shows you how fluid and how uncertain those valuations are. And often for tech companies, they're not based on fundamentals. They're not based on things like profit. You only have to look at an Uber to know that. These valuations for tech companies are driven by very different dynamics. And so I think to look at the value of these grants at the time they're given is always really difficult. And again, what people are hoping for here, even in a private late stage company, is that the value goes up such that when they exit or when they can realize value for that option grant, there's been a difference between the value at which they came in and the value at which they leave. Public company is different again. I think that is really driven by some of those companies trying to give employees some exposure to the huge growth and capital value that is being generated and normally only shared amongst the C-suite or very high-level employees. So I think in those companies, it is a genuine attempt to try and give people some cash salary and some exposure to the economic growth in the entity. Obviously, much easier to recognize value in a public company because you've got some liquidity in the stock. So as soon as you're vested, and as long as you're not in some sort of lockup period, in theory, you can recognize value. Again, that'll be dependent on whether the value of the stock is greater than the value that it was when you were granted it, which drives the exercise price. Which brings me on to, I guess, some of the study parameters, because I think in practice, sometimes there's low optionality over some of these parameters. Exercise price is a good one. In many jurisdictions, exercise price will have to be the fair market value of the stock at the date of grant for tax reasons. And so that toggle between a zero exercise price versus $1 versus 50 cents. Often a company won't exercise price on the grant just because of tax reasons. And again, I think what you're looking at there is, do I have a reasonable expectation that the value of this stock on exit will be greater than the exercise price? Because, in some respects, it doesn't matter how high the exercise price is. All that matters is that there's a delta between the price at which you exit the stock and the exercise price you have to pay. It's a similar thing on vesting. The market standard is, as you will know because you've done the study, it's the 4 years with the 1 year cliff. I was really interested to read your analysis about what late-stage companies like Amazon are doing to maybe align behavior with the vesting schedule. But in an early-stage company, almost certainly there'll be no optionality over that. There'll be no ability to negotiate that. A company will just offer that to you as their option plan. You know, this is what we're going to offer you on top of your cash salary. And then the other thing I wanted to touch on was, so other than the fact that if you're a rank and file employee in the UK getting paid more than $200,000, you're doing really, really well for yourself. I mean, we would see cash salaries for rank and file employees that were sub 100,000 for sure. Like, you know, it would only be C-suite that we're seeing salaries in those ranges. The other thing I just wanted to touch on was around the amount of VC capital raised and what that did to people's perception of the value. And I guess I wanted to come with a counter argument that doesn't necessarily follow the maths or the economics. Most of these liquidation preferences are 1x non-participating. So they're binary. You're choosing between the downside protection of getting your money back, or you're participating in the upside in an amount that's equal to your pro rata holding of the company. The reality in a downside situation is that the ordinary shares aren't worth anything anyway. And so I think when you look at amount of VC raised, you could take it from the perspective of an employee thinking, all right, well, if this goes badly, the VCs are taking all of this money anyway. That's a given. So I'm only really interested in this if there's upside. And I think there's more upside in a company which has raised more VC finance for two reasons. One, they're going to have more working capital to execute on plan, so a greater chance potentially of being successful. Two, it's validating because we've seen a greater number of VCs who have diligenced the entity who are willing to put this much money to work in this company versus another company. So I felt that there was maybe a non-logical or non-mathematical or economic argument as to why that was perceived to be of value. And then just the last point I would make, because I see that we're almost out of time, is that VCs 100% hate putting their cash to work in paying salaries. They don't like that. They don't want to put cash in and for tech entrepreneur X to take that out as a salary. They want that money to go into working capital for the business. And so I know there's some economic arguments about like the money raised should be put to work in paying cash salaries. But just as a philosophical matter within the venture capital community, that's like putting it in with one hand and, you know, Elon Musk taking it out with the other, so that they don't like that. They want to see that money going to work in the business. So I think although that is an economically rational argument as to how the money should be used, in practice, I think you will be hard pressed to convince VCs to reallocate some of that capital to paying higher salaries. And I'd be happy to discuss, I mean, there's lots and lots of things we could talk about. Happy to discuss any of it in discussion time.
Should I answer the comments now or?
Yes, please go ahead.
Great. So thank you so much for very, very thoughtful comments. So Matthias, really liked the paper you pointed me out to about the lottery tickets. I will definitely look at it. It seems very relevant. And you mentioned whether or not employees receive information from the company. So this is actually something that I did ask employees in different studies that you mentioned. And we were surprised to see how, so I think you correctly pointed out that the more senior employees, really the top talent that is being sought after, they have the bargaining power to ask for that information and to get that information. But I think that for the rank and file employees, they don't ask for the information because most of them don't know what to ask for. And when they do ask, they don't get the information. So there are two different market dynamics that are going on for the top talent and the entry-level employees. And so I apologize for changes in data. And the reason for the last minute change was that it's part of the problem when you recruit study participants through sampling platforms, that we realize that there is a significant amount of just bots that are answering the question. And so by looking at the responses to the open-ended questions, we think we were able at the last minute to clear most of them out. And this is why we made those changes. And it's a problem. The problem is that there is no public data on what's going on with the compensation arrangements in private companies. So we are looking for the next best thing using those samples, and they're not great, and they have their own limitations, as you pointed out. And what we hope to do in the next iteration of the study is to work in collaboration with venture capital firms who are also interested in this information, with a bunch of study partners to get access to employees who are answering the questions, not through sampling platforms. And we hope that they're doing it for non-monetary reasons, and they will put more effort into their responses. So I thank you for all of your suggestions, and we will definitely try to do better in the next iteration. And as for Sophie, thank you so much. I think that the distinction that you made between different stages in the life cycle of the company is point on and very relevant to what we're trying to study here. As for the exercise price and whether or not companies can game that or change it, I completely accept the fact that in important jurisdiction, for example, in the US, the exercise cost is going to be determined by the 498 valuation. But we also know that, at least at the early stages, employees can push back against this price, and what we know they're usually trying to do is to get this price lower. So there is some ability to influence the exercise price, but what's important to us is not really whether or not companies can change the exercise price. For example, I come from Israel, where it's completely up to the company to decide about the equity price and the exercise price, and companies can issue in-the-money stock options. What we want to know is whether employees are aware and know how to take this information into account. So in this iteration of the study, the stakes were very low, but in a different iteration, it could have been that we offered 50,000 stock options rather than 10,000, and then an exercise price of $1 is going to be meaningful for the employee. And you're right that it's, well, if there is a really good upside, it doesn't really matter, but it matters if you want to quit before the company goes public. And then you have only 90 days to decide whether or not you forego the grant, or you pay the exercise price and you exercise the option. And because the time to liquidity is so long, it is often something that holds employees from changing their position. I see that you...
Yeah, have you looked at, so one way we try to deal with that is to allow for cashless exercise of options. So in the UK, we have no choice around, we can't manipulate the option price. We have to go to HMRC, we have to get an agreed valuation. Luckily in the UK, we have valuation methodology that's different to the US, and so we can normally get penny options. And I'd say most companies really are trying to do that, right? Because this is valuable. They're trying to help the employees out, I would say, in most circumstances with valuation. But at some point, what we can do on exercise price is limited. But what we can do is, you know, if there's a delta on when someone leaves the company and they've got their 90 days to exercise, which is the same in the UK, if we've drafted an option grant which allows them to sacrifice such number of options as is equal to the aggregate exercise price, then that allows them to do it in a cashless exercise way. So I think that's certainly one thing that the industry looks at to try and solve for that problem.
Well, thank you. I wasn't aware how it's being done in the UK, but I know that in Israel, for example, we don't have that problem because we're using a trustee. And so the employee can exercise and still not have a taxing event until there is a liquidity event. But I think that in the US, it's pretty much by regulatory choice to keep that because it's in the best interest of startup companies, because it lowers the mobility of employees at a very critical stage for the company, where the company is very successful and employees already have paper gains. And if they leave the company before an IPO, that's a critical human capital and then leakage of knowledge about the technology and so on that the companies want to prevent, at least until the company goes public, and then also the investors can catch up. And you also mentioned what is going on with Amazon and other companies that are able to change their vesting schedule and make it more backloaded or use longer vesting schedules. So I think that it is interesting how come only companies like Amazon and really strong companies are able to do that shift, even though we heard from A16Z and other venture capital funds trying to push in that direction. And I think that once there is a standard in the industry, it's really sticky. And we can see that also in our data, that it's an anchor point for the employees. And like, how come, or why would you expect me to shift all of a sudden to a longer vesting schedule? And in terms of what do VCs want to see that is being done with their money, so to add to your point, VCs also want to see the option pool grows, because the more employees have equity-based compensation, the stronger their ties with the company are. And so I think that VCs are essentially investing in human capital and intellectual property. And so the structure of the company where employees have more skin in the game makes the company more valuable to the venture capital investors themselves. Thank you so much again for the comments. It was a lot to think about.
So sorry I was thrown out in the moment when the discussion stopped. So I want to open the floor for questions. I think the first question is by Eva Michele. Would you like to start?
Yes, thank you very much. Fascinating presentation, very enjoyable comments. So thank you very much indeed. My question would be, what are the normative implications? Because what I think we're seeing here is a situation where employees kind of know that their options are a high risk thing that they're getting themselves into, but they're taking them because they maybe enjoy being part of the dream of being part of this vibrant entrepreneurial startup culture. And then the question is, how would labor law best react to that? And that would be, I'm really interested in this. And the other thing, just a comment, this reminded me of a situation we had in the UK a number of years ago where gym memberships involved a 2-year period that you had to commit to. And the evidence was that no one actually went after 2 weeks. And then the competition authority and stepped in and interfered with those contracts on the basis that, again, this was this dream. I'm an incredibly fit person and I'm the person that goes to the gym, and then I never turned up. But yeah, so just the labor law implications of your evidence.
I would suggest to collect 3 questions and then we give the floor back to you, Yifat. So the next is Anat.
Yifat, thank you so much. This is great. You know, I love your work, and I think this is a great contribution to the literature. I just have 2 kind of comments, questions. One is, I don't know if you had a chance to, and they would be interesting to check. I've been seeing studies, and it would be nice to contribute to that younger employees no longer exercise their options. We've seen 50% dropout in that respect. And I wonder if you've been observing that less than 50% are actually exercising. And is that driven because of lack of information, because of the risk that's associated? Is it because of the higher valuations that we're observing in the market? That's one. The second is if you've had the opportunity to separate it between early hires and late hires, right? Because we know that when you enter into the firm, right, it also changes, first of all, what you actually get and the value and whether it's going to be underwater or not. And what I would suspect is that later hires are going to be the ones that are going to leave first, right, and kind of diversify their portfolio. So thank you.
Thank you. And Aran?
Yeah, I have a small comment and a suggestion. The comment is I didn't understand why you didn't deflate the capital raised by the number of employees. That is, why didn't you look at capital raised per capita in the company? The suggestion is to look more about how many of your peers have taken the offer, and particularly who among your peers have taken the offer. So if the top management have taken the offer, that's an indication that they know more than me, and therefore it's a good idea to follow. And B, probably they have taken better financial advice. So that solves a bit of the financial literacy issue.
Great, thank you. So to the first question, I'm sorry I didn't get the name of the person who was asking the questions. As for the normative implications, I've written about it in other papers. I think that equity-based compensation is such a fascinating phenomenon, at least for me, because it falls in between different categories. It's not exactly employment law, it's not exactly securities law, or at least it was, companies were able to create the perception that this is a benefit to employees and not a securities offering, even though it is. And so all the rules that apply to securities offering, the way we think about investors, we don't really apply those when we think about employees. They're sort of should say thank you for allowing us to participate in this wealth creation, but they don't get the same information that investors get as option holders. They don't enjoy fiduciary duties or have standing to bring lawsuits. So they are in a really, they fall in between the chairs of different legal frameworks that we can apply to this situation. And at least what I'm trying to do in my work is to try to think about employees who are being compensated by equity as a special class of investors that should enjoy some rights, maybe not all the rights that we give capital investors, but trying to think about human capital as the scarce resource that we're trying to allocate efficiently, and then knowing that we have all those problems in the securities market, why would we think that these problems would not apply when we think about the labor market and the way that talent allocation could be influenced when we start using securities as a meaningful source of compensation? And then you asked, how do employees think about it? So in my other work, I show that there is a really wide variation between the employees who are more experienced and understand more about how this system works, and they tend to think about it as some sort of a lottery ticket. And the employees who don't know much, and they think of it as a sort of an investment or a savings plan. And that is a lot more risky to my mind, especially when we're talking about startup companies. Because if they're reading the news or thinking that I work for WeWork and I'm going to be a millionaire, or I work for some other unicorn that has raised so much money and they're trying to adjust their lifestyle and so on, it's not a healthy way to build your wealth. And I started actually to work on this issue by observing the behavior of some of my friends who were working for private unicorns. And as for the implications on unemployment law, I think what I'm trying to do in my work is to create this meeting point between securities law and employment law, and to show that we treat it as a very binary distinction, but the way the market behaves it really starts to converge. And while there are many protections to employees under employment law, all of a sudden when we pay them with securities, all of these protections sort of disappear. And it could be good in some way, but it also has problems. And it becomes more of a problem when we start talking about paying gig workers with equity, and we think of it only as a benefit. But if we know that employees are responding to it and they're over-optimistic about it, it could also be a problem. Anat, thank you so much for your comments. Anat has written extensively about this issue, and I always love reading your work. And I don't know exactly what percentage of stock options is not being exercised. I know that companies such as Carta and the other companies that have cap table data talk about on about 70% of stock options that are not being exercised. And there are many other companies that are trying to create solutions to this problem, or trying to come with a product that allows them also to benefit from this product. So, for example, EquityB, SecFi, and so on provide marketplaces where investors can offer loans to employees to cover the exercise price and the tax costs, and then share in the upside. And from my viewpoint, it's not an optimal solution, because here again, employees are losing half of their upside to capital providers because of the way our legal structure is built. And as Sophie mentioned before, this is not a problem that has to be. This is created by regulators and by the legislatures. Oren, thank you so much for your suggestions. I will definitely try to make the next iteration more sophisticated. And as for employees looking at information of what seniors are doing, they don't always have that information, especially if you are looking at employees who are just joining the company and not employees who are already at the company. But I think with regard to some decisions we do, for example, the decision on whether or not to participate in secondary sale of securities. If the company is holding a secondary liquidity event, many employees will look at their bosses and the senior people in the company and see what are they doing. Are they selling? And if they're selling, it's a good indication that it's maybe better to cash in now rather than wait until the company goes public. But it's not always possible to do it when you are just looking for a job and not already within the company. Thank you.
There are two more questions, and I would quickly like to go to them. So first is by Simon.
Hi, thank you. Great and interesting presentation and discussion. Thank you. Very quick, and it's not a question really, it's more an observation. You're probably already aware that there's an organization in the US called Ownership Works, a not-for-profit, which is really pushing employee ownership, and not in venture capital as far as I know, but in private equity. This has been endorsed by the likes of KKR, Apollo, TPG. You might have seen that KKR recently exited a company, gave every employee earning less than $100,000 equity when they bought. They said that was a free gift. There's no such thing as free, of course, but they said it was free. Wasn't in relation, didn't involve any sacrifice of salary or benefit, and involved those employees getting an average payout of $175,000 when they exited the company. So I just sort of make that observation because to the extent that you think there is in reality a trade-off, to the extent that it has some impact on behavior, I think that in the private sector, in the private equity sector, in the private company sector more generally, there is a push, mostly according to the private equity firms, based on their desire to tackle social inequality. There is a push for much wider employee ownership. So I think this is going to become not just a venture capital phenomenon, but a private equity phenomenon as well.
Thank you. And the last question is by Casimiro.
Hi, Yifat. Thank you very much for your presentation once again. My question is actually about a topic which also Anat has brought in extensively about it, and it's about how this the discussion that you actually have put together relate to the topic of information rights within companies, because it might also be somehow, or it might have implications also for corporate lawmaking when you see how actually this stock option work and how actually the employees in the company inspect the books in order to understand whether the value of the stock option is right or not. And I see that there are potential implications for regular law, but I wonder also whether in your discussion you might incorporate some stuff about corporate law implications, because I think that might also be relevant. I mean, I can't really articulate now a discussion about it, but I see that there's some potential. Perhaps Anat can help me more than anyone in discussing.
Thank you. So given we're out of time, could you either respond within 10 seconds or maybe usually I would like to direct it to the non-existing coffee break, but maybe 10 seconds, okay? And then we move on.
Yeah, so thank you so much for the comment on the equity, on the private equity. It's completely true, and I think it will become more relevant. And that leads me to Kazimier's point. I think it's going to be, employees in corporate law are going to become a larger issue. For example, we think about co-determination only in the sense of employees as stakeholders, but if we're talking about technology companies, employees hold 10 or 20% of the stock, so why not board representation? That's one way to think about it.
Okay, thank you very much. And we move immediately to the second page.